Good afternoon, everybody. Thank you very much for joining us today on this webinar. For those of you who don't know, the Energy Institute is an independent network of professionals spanning the whole energy system. We convene and facilitate debate. We bring together expertise so that energy can be better understood, managed and valued. I'd like to introduce to you our chair for this webinar, Sarah Vaughan, Political and Regulatory Affairs Director at E.ON UK. Sarah, over to you.
Thank you, Laura. And good afternoon, everybody. I'm delighted to welcome you to this webinar today. And I do want to just remind you up front that the webinar is being recorded. So today we're going to be looking at the International Energy Agency's Gas Security Review report, which was published yesterday. And we're really fortunate to have with us today two of the report's main authors, including Jean-Baptiste Dubreuil, who led and coordinated the analysis. I'll introduce Jean-Baptiste and his colleague Gergely in a minute, but first I just wanted to let you know how to ask questions in this webinar. We're all using many different systems at the moment, and I think they're all a bit different. So just for your information, the way that you do it in this one is that you click on the chat icon at the bottom of your screen, click the drop-down menu and select my name, Sarah Vaughan, and ask your question directly to me. And we'll try to include in the panel discussion at the end as many of your questions as we possibly can. Also, at the end of the webinar, we'll see a brief questionnaire pop up once you leave the session. And we'd be really grateful if you could just take a moment to fill it in. So turning back to Jean-Baptiste and Gergely. Jean-Baptiste Dubreuil has been at the International Energy Agency since 2017, where he is a senior natural gas analyst. Before that, he had over 15 years experience in energy with major oil and gas industry, research and services stakeholders. And before joining the IEA, he held several economic analysis management positions within ENGIE, a leading global energy provider at both corporate and business unit levels. And Jean-Baptiste also has academic experience as an invited lecturer in oil and gas markets. His colleague is Gergely, Molnar, who has been with the International Energy Agency since August 2018 and is a gas analyst in the Gas, Coal and Power Markets Division within the Energy Markets and Security Directorate. Before joining the agency, Gergely held several positions in consulting and in private research companies with a focus on European gas markets and gas infrastructure. So I think we'll all agree that we're in the presence of real experts here. And with no further ado, let me hand over to Jean-Baptiste and to Gergely. Thank you.
Good afternoon, everyone. Thank you very much, Sarah, for your kind words of introduction, and thanks a lot to the Energy Institute for inviting us and for hosting this presentation today. It is our pleasure to share with you today the main finding from this annual gas security review, which this year, given the context of the unprecedented crisis triggered by the coronavirus pandemic, our review is providing a special focus on flexibility and security of supply during the first months of the year, and is supplemented by an update on our gas market report and short-term forecast, which now becomes a quarterly report and is fully and freely available on our website. So, since we started this global gas security review 5 years ago in 2016, the purpose of the analysis has been to monitor the trends in gas supplies, particularly in LNG contracting by natural gas, assessing the flexibility of the LNG market. And you can see on the screen the main indices that we track in terms of flexibility, destination flexibility, the duration of contract, and size of contracts. So first, one key finding from this year is the collapse in contracting activity. We see that as of we speak, beginning of October, we have had about 35 billion cubic meters, BCM, of LNG volumes contracted so far in 2020, which is a far cry from the 75 BCM of last year and 95 BCM 2 years ago. So this collapse, of course, owes to the very specific situation that we're currently living in with the COVID pandemic, but also to the fact that the LNG was already a very well-supplied market at the end of last year. In terms of trends, see that when we look at those three factors that we monitor, flexibility, duration, size of the contracts, see that this year buyers opt for less flexible, smaller, and shorter contracts, which is a rupture from what we've seen in terms of trends for the past 5 years. Those three changes go all hand in hand together because what we have seen in the past, larger volume being issued on new greenfield projects from the United States, from other regions around the world, especially on the basis of flexible destination, as you can see on the left-hand side, the dark blue bars. Those volumes have been mainly resold this year by intermediate players, we call portfolio players, major international oil and gas companies, major utilities, who resell some of the equity they have in these projects. And as these buyers opt for smaller, shorter commitment, also goes with less flexible destination. So it doesn't question the overall trend that we've seen in the 5 past years, but it is clearly a rupture with the previous years. Looking forward in the future, in the next 5 years, there are several trends that will definitely reshape the global LNG trade as we see it today, as we've seen it in the recent past. The first one you can see on the left is that about a third of contracts currently in force are to expire. About 200 billion cubic meters of contract are due to expire in the next 5 years. Second aspect, at the same time, the capacity, overall supply capacity in terms of new liquefaction plants is increasing. And as we speak, the new capacity from projects which have already been sanctioned by investment, which are under development, account for a 20% increase in overall capacity in the next 5 years. You can see on the middle graph, the capacity expanding from 600 to 700 billion cubic meters. The combination of these two factors, the expiry of existing contracts, the increase of capacity in the next 5 years, plus, of course, the overall uncertainty on the future trend of demand, build up to create an increasing amount of uncontracted volumes. You can see as the green bars on the central graph, which increase fourfold in the next 5 years to 200 billion cubic meters, considering, of course, the contracts in force currently, which gives a measure of the importance of the opportunity and the challenge for players on the LNG market. Last factor I would like to highlight, in terms of pricing, on the right-hand side of the chart, you see that indexation is moving slowly but surely towards more hub-to-hub competition, less oil linkage, and a bit more of diversification with hybrid formulas. It is a long-term trend. Oil indexation remains the main source of pricing for LNG contracts, but it's being challenged by new sources of LNG, namely from the United States, and also by the expiring of legacy contracts. As I said at the beginning of the presentation, this year we're making a special focus on what happened over the recent months to see how flexibility, security of supply was at play during the COVID crisis, especially during the first half of the year. And as markets were faced with an unprecedented fall in demand, which resulted, of course, from the COVID crisis and the impact of lockdowns, but also from a particularly mild first quarter with very high temperature for winter average all across the Northern Hemisphere. The conjunction of those two factors have led to an estimated 4% fall in global gas demand for H1 2020. So faced with those unprecedented circumstances, the whole gas supply chain had to provide flexibility to adjust supply at all the levels of the chain, including production shut-ins, contractual flexibility mechanism to reduce the volumes, or storage utilization. In terms of trade, it was the pipeline suppliers who bore the brunt of the impact, but at the same time, LNG suppliers were instrumental in providing flexibility, and they have had experienced varying degrees of supply curtailment. As you can see on this graph, the United States accounted for the biggest share of the downward adjustment in global LNG supply, with roughly a third of the downward adjustment of 7.5 BCM, or about 17% decline in between January and July 2020. Other suppliers, of course, did experience export declines. You can mention Australia and Malaysia. You see the names on the chart, and a handful of others, especially Qatar, managed to increase production during the pandemic. What is really important to highlight is that without the flexibility of global LNG supply, particularly of US supply, the adjustment on the supply side of that 2020 H1 demand shock would have been certainly less orderly. It could potentially have led to damaging impacts on the commercial and contractual structures underpinning the global gas trade. I would like to leave the floor to Gergely, who will guide you through a more detailed analysis of the impact on the European market.
Good afternoon. In the next couple of slides, we would like to focus on the European gas market. European gas markets faced the perfect storm in the first half of the year. Gas demand was already depressed before the start of the first lockdowns. Heating degree days were down by approximately 5% in the first quarter of the year, which naturally depressed gas demand in the residential and commercial sectors. In addition, we had very strong winds. Wind power output was up by over 1/3, which weighed on thermal power generation and depressed gas-fired generation in the first half of the year. Altogether, European gas consumption before the start of the lockdowns decreased by 4%, or almost 5 BCM. The imposition of the lockdowns had, of course, a very significant impact on European gas demand, falling by 11%, or 10 BCM, between early March and end of May. On the right-hand chart, you can see the impact of lockdowns by sectors for a sample of countries. Lockdowns have been primarily impacting on the industrial and power sectors, while distribution network consumption has been less impacted. European electricity consumption decreased by 12% under the lockdowns, severely weighing on gas-fired power generation, which plummeted by over 20%. Industrial gas demand in countries imposing stricter lockdown measures have fallen by over 15%. We started to see first signs of gas demand recovery in June, and this trend has continued. In contrast with the first half of the year, European gas consumption increased by over 3% in the third quarter, almost entirely driven by the power sector. Despite declining electricity consumption and rising renewable output, gas-fired power generation increased by over 4% due to shifting fuel dynamics in the power sector. The largest contributor to higher gas burn was Turkey, where gas-fired generation increased by an impressive 34% or 5.5 terawatt hours. And this has been primarily due to lower lignite-fired power generation, which has been restricted due to environmental reasons and due to lower hydro availability. In Northwest Europe, as a result of the COVID-19 outbreak, the maintenance schedule of several nuclear power plants has been adjusted. In France, the outages at several nuclear reactors has been extended, which resulted in a decline of 20% in nuclear output. In absolute terms, this translates into 17 terawatt hours. The outcome has been additional market space for other supply sources, both in France and its main electricity export markets. Most of this has been captured by gas-fired power plants. In fact, the very low gas prices combined with the sharp recovery in carbon prices increased the competitiveness of gas-fired power generation vis-à-vis of coal and lignite, which fell by 8% year on year. The switch has been particularly large in Germany, where gas-fired power generation increased by over 10%. And preliminary data from certain markets suggest that the steep fall in industrial gas demand we have seen in the second quarter has been moderated. In France and Spain, industrial gas demand has fallen by 3% and 4% in the third quarter, against 13% and 17% in the second quarter. And in Belgium and Italy, industrial gas demand rose by 1% in the third quarter. Following the demand side, let's have a look on supply. Despite shrinking gas demand, global LNG supply remained particularly strong in the first 5 months of the year, when it increased by over 8%. In this context, Europe played a crucial role in absorbing incremental LNG supply, accounting for almost 2/3 of it. This, combined with shrinking gas demand in Europe, weighed naturally on the pipeline supplies into Europe. We have seen Russian and North African exports to Europe plummet by 25%, and Norwegian deliveries declining by 5%. This trend has been changing since June, with European spot prices falling to record lows and the transatlantic price spread between TTF and Henry Hub collapsing close to zero, resulted in lower LNG imports into Europe, falling by over 10% year on year during the period between June and September. As a consequence of lower LNG imports and the recovery in gas demand, we have seen that the steep fall in pipeline supplies has been moderated. North African exports into Europe, in fact, increased by 6%, and Norwegian deliveries were up by 16% year-on-year during the third quarter. Russian exports were down by 18%, and while both Nordstream and the Yama pipeline running through Belarus had utilization levels of above 90%, exports via Ukraine halved. And this is partly due to the increased utilization of virtual reverse flows. These reverse flows contributed to the higher net storage injections in Ukraine, which in turn might contribute to higher exit flows from Ukraine to Europe in the fourth quarter. What is next for Europe? After the sharp decline in gas consumption in 2020, we expect gas demand to recover and remain stable during the forecast period. In the power sector, the gradual phase out of 50 gigawatts of nuclear, coal, and lignite power generation will create additional market space for gas-fired power plants. However, growth will be limited by the rapid expansion of renewable sources, set to increase by almost 30% through the medium term. Industrial gas demand is expected to return to pre-crisis levels, but upside growth potential remains limited. Despite stagnant demand, Europe import requirements are expected to increase by 10% or 45 BCM per year by 2025. And this will be primarily driven by the declining domestic production in Northwest Europe, including the Netherlands, where the Groningen field is set to close by mid-2022. Norwegian supplies are expected to remain stable, providing flexible gas supplies to the rest of the continent. Europe's growing import requirements and the expiration of legacy supply contracts create market space both for traditional and emerging pipeline suppliers, as well as for LNG. The commissioning of the TAP pipeline in fourth quarter of 2020 will allow Azeri gas supplies to increase by 8 BCM per year through the forecast period. Russian supplies are expected to fluctuate in a range between 170 and 200 BCM and will be supplied through a combination of long-term contracts, auctions, and direct spot sales. After a record of 115 BCM of LNG imports in 2019, Europe is expected to continue to play a key balancing role in the global gas market. We expect that European LNG imports will oscillate in a range between 90 and 110 BCM through the medium term. Thank you.
Thank you, Gerge. Now, moving back to the global analysis, we have just illustration of what Gerge was just mentioning in the European case. As you can see on this chart, as a result, of course, of the demand collapsing, you see all that natural gas prices indexes have taken a strong slide over the first half of the year. The European TTF was down 55% in the first half of the year. The Asian LNG spot price down by 65%, and US Henry Hub down by 20%. We can see also that some recovery is underway as prices are recovering throughout the summer on a combination of higher demand as Gergi mentioned, also some supply side adjustment. And however, this recovery will not be sufficient to compensate for the losses that we've seen in the first half of the year. And the assumption that we take for this forecast is that the next years that this year global gas consumption will fall by 3%, which will be its larger decline ever recorded. It's about 120 billion cubic meters, as you can see on this chart, where we have chopped in regions the impact of the drop in the forthcoming recovery that we anticipate. Most of the decline is expected to come from mature markets, mainly in the Northern Hemisphere, North America and Europe, Eurasia, and some Asian markets, where the combination of the mild first quarter and the impact of the lockdown measures are taking their toll. And 80% of that drop coming from those mature markets, whereas some fast-growing markets, especially in Asia, thinking about China, for instance, are still experiencing positive growth this year. We do expect that next year, 2021, global gas demand will rebound and return to its 2019 level with a 3% increase, or about 130 BCM of recovery, which is more or less returning to last year's level. So it's not a major rebound. This is likely to be more gradual, driven again by fast-growing markets in emerging Asia and the Middle East and in Africa, while the more mature markets in OECD countries are likely to see more progressive recovery, and some of them may not return to their 2019 level by the end of next year. After 21, as you can see, for the next 5 years, we do anticipate that the bulk of the growth will come from Asia and from the Middle East, driven by accessibility to affordable supply and also by strong political support in markets such as India and China. However, the growth is not going to be as important as it used to be in the past, nor as important as we thought it could be at the beginning of this year, because the COVID-19 is going to have lingering impacts on the global energy system, including natural gas, of course, both on the demand side, with huge uncertainties on the trend for recovery, and on the supply side, with additional capacity. I was mentioning earlier the case of LNG. So on this chart, you have the schematic LNG supply-demand balance, and you see that the curve showing the utilization rate of liquefaction of supply capacity. So it's dropping this year. We do not expect it to recover strongly in the next 5 years, because demand growth will be outpaced by the addition of new capacity. So we do expect that the LNG market will remain a loose market for the coming next years, except if some additional demand is triggered by even lower level of prices. Anyhow, this potential for a loose market for the next year is likely to cast a long shadow on future investment in the oil and gas sector, which could raise some concerns, some security and supply issues in the longer term to replace the declining existing capacity in terms of production and infrastructure. So to finish this presentation, I would like to highlight some of the key findings from the report, which is again fully available from our website. First, in terms of contracting activity, we have seen that there was a strong activity culminating 2 years ago in 2018. That LNG contracting slowed down last year and collapsed in 2020 to date. On the well supply market, demand decline and certainly caused by the COVID-19 situation. In the next 5 years, the expiry of legacy contracts, which account for about a third of current active volumes, together with an increase in new supply capacity, will redefine the structure of LNG markets, create new opportunities for buyers and new challenges for marketers in the context of large demand uncertainty. The unprecedented demand shock that we've observed over H1 called for action to adjust the supply capacity. And flexible LNG was a key contributor to that adjustment globally. Total LNG trade declining by 17% over H1, principally supported by US exports. Demand is progressively recovering since the beginning of summer, yet we still expect 2020 to be the largest recorded drop in gas demand, with 3% year-on-year decline. If global gas demand is to recover next year, it is not going to be a major rebound. Some mature markets will still be below their 2019 level by the end of next year. Since the beginning of this crisis, the International Energy Agency has engaged with all stakeholders, the governments and the industry to assess the impact of the crisis on energy markets and security and to develop the roadmaps for sustainable recovery. Today, we're releasing our World Energy Outlook, which highlights both the impact on the long term of the COVID crisis, also the pathway to recovery, to clean and sustainable energy recovery and growth. Part of the efforts that we are making at the IEA to contribute to these roadmaps to recovery are natural gas market analysis and the short-term forecast that we have displayed today will now be updated on a quarterly basis to better track the developments on the markets and further increase transparency and understanding. Thank you very much for your attention.
Thank you very much, Jean-Baptiste and Gergely. That was an absolutely fascinating presentation of what has clearly been quite a torrid time for world gas markets. Just to remind you all, if you have questions for our panelists, you can ask them by clicking on the chat icon, going into the drop-down menu and selecting my name, and then asking the question directly to me. But in the meantime, while you're thinking about your questions, I have actually got a couple of questions that have come in already. So let me start with those. I think if one just sort of reads the press and you know stays connected with what's going on in the industry, you've heard a lot about the impact of COVID on oil demand, for example. Why do you think that gas has shown relatively more resilience so far than oil has, or indeed than coal has in the market? To either of you. Jean-Baptiste, thank you.
Well, actually, thanks, Sarah, for this question. Actually, the figures that we have been displaying today with the release of the World Energy Outlook is showing some estimates for this year. Global energy demand is expected to drop by 5%, all sources of energy together, whereas gas is only, into brackets, 3%. So it shows some of that resilience of natural gas. As you rightly pointed out, it is because oil and coal particularly have been more impacted by the crisis on two reasons. The first one, I think, owes to the structure of power generation in many countries where gas and coal are competing, and the fact that the well-supplied gas market has given an advantage over coal in terms of prices, also some regulation limiting, as Gergely mentioned, in the case of Turkey for lignite, limiting some emission. We've seen also the case in Korea over the spring. So this combination of regulatory and economic impetus has given a premium for gas over coal. One of the important landmarks for this year is that for the first time ever, gas has been the leading source of power generation in several US generation districts, including in the Midwest, which is the heartland of coal production for decades. So this is for the first one. The second one with oil, owes to the fundamental structure of gas demand. Oil is particularly impacted by transportation needs, whereas transportation for natural gas only accounts for roughly 5% of overall consumption. So this owes again to the very specific. Otherwise, gas was much more impacted by the temperatures that we have seen over the past winter compared to coal or oil, because about 20% of global gas consumption is temperature driven because it's residential consumption.
So actually, just following on from that, what would you say is the greater risk to gas demand looking forward? Is it COVID or is it the weather if we carry on seeing such mild winters?
Well, that's a very tricky question. But thanks for asking it. I don't know with which factor I'm taking the most risk, but well, certainly the role of gas in fast-growing markets, especially in Asia, has been favored by strong policy support. If I'm thinking particularly of China and India, in both these countries, gas is playing as fuel for growth, so fuel for substitution for cleaner air in major urban areas at the expense of coal. If taking into consideration that these two countries are producing gas, but they are importing the majority of their gas needs. If the economic situation continues to depreciate and the priorities of these countries in terms of policy making is refocusing more on domestic sources of energy at the expense of importing LNG or pipeline gas, of course, the trend in terms of gas demand growth in these countries could be affected. Reversely, we've seen that other emerging Asian markets, whether it be in South Asia with Bangladesh, Pakistan, or Southeast Asia, are also exposed to oil and coal switching, but they are much more price sensitive and opportunistic. So if we still see very low and competitive LNG import prices, these markets may see more growth in the coming years.
Okay, that's interesting. Thank you. We've had a question in from Peter Godfrey. Thank you, Peter, saying, do you think that the need to greenify LNG will have an impact on LNG markets?
Well, I certainly see that this is an important part of the change in the role of natural gas. Natural gas, as we see from a short-term perspective, I was mentioning clean air policies in Asia, but also from a longer-term perspective, natural gas is part of the solution towards a cleaner, more sustainable energy system, but it has to, so to speak, do its own homework to make sure that it remains part of the solution and not part of the problem. And to address those problems, there's the question of addressing the environmental footprint of producing methane, so ensuring that methane leakage is monitored, and also ensuring that natural gas ensures its transition to a more sustainable and greening gas. So I think this is part of the answer, not only for natural gas, for LNG, but for the whole natural gas supply.
Okay, that's interesting. We've also had a question in about trading. You've talked about the fall in gas demand, but the question is around the impact on gas trading and how liquidity has actually evolved under those conditions, and particularly in light of the measures that producers have taken, for example, holding gas back that you talked about.
So I think that when we look at physical trading, and John Baptiste highlighted this interregional pipeline trade born the brunt of the impact of the COVID crisis, interregional pipeline trade decreased by approximately 15%, or roughly 40 BCM. We have seen lower exports from Russia to Europe, lower exports from Central Asia to China, the trade between Canada and the US shrinking as well. I think that, when LNG was sort of starting to adjust, it was already in starting from sort of May, June. But I think it is equally interesting to look at how paper trade reacted to that situation. And when we are looking at what happened in Europe, which played sort of a balancing role in this entire context, we see that on TTF in the first 8 months of the year, gas trading has been up by about 20%.
Okay.
Despite the lower consumption volumes. Now, the impact of that is that the churn rate has been also increasing substantially by over 1/4, which, again shows that probably the liquidity has been improving on that market. Another interesting aspect of European gas trading is that we have seen an increasing move from OTC to the exchanges, which could be a sign that there is also more interest from non-European participants in the European gas market. And of course, the third aspect is that the increasing role of TTF, which accounted, I think, for almost two-thirds of the trade being made in Europe. And providing, hedging value, not only European players, but also other participants.
Yes, okay. Thank you. We've had a question in from Peter Newman. A very simple question. I'd love to hear your answers to it. Will Nord Stream 2 get completed anytime soon? I don't know if you both want to have a go at that. Let's see if you come up with the same answers.
Well, we are doing forecasting in terms of markets, and Nord Stream 2, as far as other projects being on the drawing board, where we're talking about LNG projects or a new pipeline project, I think are more in the realm of the companies which have invested into the project than our competence to say if they are to be completed or not. So what we see currently is that, has been shown by Gerge, European demand is not likely to expand largely in the next years, but there will be additional need for imports to compensate for the decline of supply. And we have seen that LNG has played a very strong role in ensuring that supply in the recent past. But at the same time, Russian gas is still a very important source of supply, and with long-term contracts which will be in place until the late 2030s. So the picture is not likely to change that much on the demand side, but we'll see how it goes on the supply side. So really, the further decline of domestic production opens additional space for new supplies to Europe.
I think that's a very good answer. Thank you. I was interested in the comments that you made around the pipeline contracts having borne the brunt of some of the reductions that we've seen, but we also saw quite a large reduction in exports from certain countries, and the US, Australia were highlighted as some of those examples. The contract flexibility in LNG contracts, do you think that's an advantage or a disadvantage for players in the LNG market?
Well, I think it works both ways. It really depends on which
side you're on.
Which side you're on first, and what is the configuration of the market. It's true that so far LNG was mainly accustomed to be in a tight market environment, which is less the case today. This is where it really makes sense to see that flexibility is not only a thing on paper saying that, okay, you're buying flexible but nobody cares about flexibility when everybody's wanting that LNG. And then you see that the demand is collapsing and LNG is really flexible, and genuinely exports can decline by almost 20% in less than 6 months.
Yes.
Well, of course, in terms of logistics, practical day-to-day, pipeline is much more flexible because your nomination are on a daily basis, whereas once you have hired a cargo, it's much less difficult to make it flexible unless you want to reroute it somewhere else. So I think that those are complementary on different time scales.
Okay, understood. I think on one of your slides you talked about limiting the risk of a tight market looking forward. Are we actually looking at quite a soggy market with quite a lot of overcapacity with all of the investment that's been made, in your view? Soggy not being a technical term, I accept.
Well, the figure that we have shown is an annual average, and there again, we'll have to take into consideration the very specific seasonal pattern that owes to natural gas, especially when you compare it to oil. If we go back a couple of years ago, we've had a similar situation in 2015-16 after the collapse in oil prices, where there was an oversupply in the LNG market. And then the market tightened very quickly on the brink of a very cold winter. And as China was expanding its targets to replace coal heating devices by gas heating devices in major urban areas. So I think that the seasonal swing has a very strong impact. And for countries such as China, the domestic storage capacity and domestic swing production capacity is still very minimum compared to the requirements. So even if the overall picture is quite soggy, as you say, in terms of capacity use, I think that we can still see, depending, of course, on the weather forecast, on which it's we can't even make any prediction. But if we see more harsh winters in the future, there will be more seasonal swings and more volatility in prices.
And of course, you're right. Nobody ever knows quite what the weather is going to do. We've had another question in from Peter Newman, which is one that relates to power generation. Actually, do you have a view on whether European power generators will be obliged to install carbon capture and storage in order to be allowed to continue to operate? And if so, what assumptions as to when? Gergo,
I think that carbon capture and storage is part of the solution. As Jean-Baptiste mentioned, the gas industry has to do some homework. I think that in the longer term, to reach our environmental goals, to reach net zero in terms of carbon emissions, this is something which has to be done, and it shall be encouraged by different policy tools. I think that the question is rightly by when we are going to see, and to be honest, we haven't seen that happening in our medium-term forecasts. But okay. I think that when we are considering the longer-term forecast, and today's World Energy Outlook is a very good example of that. It is definitely part of the solution, especially in Europe, where we obviously will need to have some gas-based power generation to provide flexibility to the increasingly renewable dependent power fleet. But I just really would like to also highlight that this is one part of the solution. I think that biomethane, hydrogen, and other clean gases has also had to be part of that solution. But CCUS is certainly something we see as part of the puzzle. Thank you.
Yeah, I think you're right. I think that there is a very mixed solution. With I think solar is one of the things that is highlighted in the World Energy Outlook report that's been issued today. But certainly, gas with CCS, I would agree with you, is part of that. There was something you talked in your presentation about the portfolio players. And one of the things that comes out of the report is around the portfolio players' contracted ratio, which has fallen quite dramatically from around nearly 85% in 2016 to potentially as low as 55% by 2025. All things being, and that's all things being equal, that feels to me, and maybe I'm just a very cautious person, as quite a big risk for those players in light of what we have seen. Does it suggest that we're looking at a bit of a buyer's market going forward? What's your view on that?
Well, the overall fundamentals will definitely point out towards a buyer's market. As for the portfolio players, we're really focusing. It's a very large definition of a class of players, but we are focused on the main ones, which encompass major oil and gas companies and major utilities who really have a buying and selling regular activity of LNG, not a ad hoc just transaction. And there's a general trend that these companies have taken a very bullish stance on the development of LNG, especially in the eastern hemisphere of the globe. And looking forward to this, they have taken very strong open position on the buying side in new projects. We've seen last year a record of almost 95 BCM of new capacity being invested in new projects. So that's more than the annual increase in global gas consumption last year. And also those projects have been financed by equity coming from these major portfolio players. So of course, this will be part of the challenges for these players in the next 5 years to actively look for new markets. Providing also some sort of new forms of flexibility, not only coming, of course, some buyers will still be looking for so-called legacy contracts on the long term with the classic oil indexation formula because it's easier to hedge, it's easier to manage from a utility perspective. We also see new buyers who would be more attracted by smaller quantities, being more attracted by cheap supply sources and having hybrid formulas. And I think that the advantage of those portfolio players is that they have sufficient mass on the market to be able to propose and structure those products for those new buyers. So I think that they're also part of the solution to a transition to a more wholesale market behavior and more trading, more transparency and flexibility on the LNG markets.
Thank you. We're almost out of time, but we've had a question that's come in that is really around the present. So what is the panelists' outlook for LNG demand during the upcoming winter for LNG, considering there is excess regas capacity in Europe, Russian gas is flowing, storage is stacked high. What's your view on Asian demand for the winter and into the summer? And that's from James O'Brien. Quite a lot packed into that.
I'll give it a first stab, and Greg, if you could please elaborate further on, particularly on Europe, if possible. So globally, as I think that you have provided a good summary of the situation. It doesn't look very bright in terms of supply needs. Of course, again, there's a big unknown of how cold this winter is going to be. And on this one, we have no clue, except that some meteorologists have highlighted the return of La Nina in the southern hemisphere, which may lead to some colder temperatures in the northern hemisphere for the winter. But apart from that, which leads to speculation, I think that there's indeed the fundamentals of demand, with storage capacity being quite booked in Europe and in North America. And at the same time, there's also the competitiveness of the different sources of supply. And what we have seen this year, especially in LNG, is that most of the growth has come from opportunistic buyers.
Yeah.
So far, our estimate is that LNG growth for the 3 first quarters has been about 3% year on year. And all of that absolute growth came from opportunistic buying, coming mainly from China, India, and Asia. So and Thailand. And in these 3 countries, we have seen, in spite of quite sluggish demand, we have seen an increase in LNG imports because it was cheap, basically.
Yeah.
So those players, they have either lowered their own domestic production capacity or switched in order to accommodate for more affordable LNG to come in. So I think that this is also part of the answer to the LNG conundrum for the coming months, especially how the wind blows in Asia, so to speak, and how competitive will LNG be on those markets.
Yes, indeed. Gergely, do you want to come in with a comment? So we have about a minute that you can comment, if that's okay.
Yes, now just really quickly add on the European picture. When we look at European gas storage, as rightly pointed out, it is pretty high, about 95% full. So, the balancing role it can play, for instance, in the beginning of this spring, for instance, it is not available now. And the second point, which I feel is sometimes overlooked, is that, of course, Ukrainian storage is now increasingly interlinked with the European Union's gas market, and we have seen this happening. And Ukrainian storages are quite full as well. And what we can expect is higher exit flows from Ukraine to the European Union's gas market through this winter, because we have seen a lot of net storage injections in the last quarter in Ukraine, which was facilitated again by virtual reverse flows. And when we look at the first 10 days of October, we have seen already a much more robust exit flows coming from Ukraine. They almost doubled what they have been in September. So this will naturally, impact on how much additional LNG can Europe receive.
Okay, thank you. Unfortunately, we're now at 13:28. There is another question that is sitting there from Konstantinos Pantazopoulos around, in the event of a second severe COVID wave or geopolitical events, do you see projects such as the TAP project being pushed back? I fear that we may not be able to get to that unless you have a very quick comment on that. Gergely, does that sit with you?
Yeah, just to say that it is 99% ready. So I would not expect that TAP is going to be severely impacted by that. Other projects might be, but not in the case of TAP. It is almost ready to go.
Well, that's a fantastic, very clear and brief answer. So thank you. Thank you to both Jean-Baptiste and Gergely for a really, really interesting presentation, and for taking so many questions from people as well. Just to remind everybody that this has been recorded, and that the recordings and the materials will be available to you, and that there will also be a sort of a survey that will pop up, and we would ask you to complete the survey because that is always helpful. So thank you everybody for joining us today and for the questions that you've given us. I personally have found it a really, really interesting hour. So thank you all, and goodbye.